Welcome to The Deep Dive, the show that extracts the essential knowledge from the financial world so you can be well-informed without drowning in documentation.
Glad to be here.
Today, we're focusing on one of the most hotly debated technology names in enterprise software, Workiva, ticker WK.
That's right. We are deep diving into their Q3 2025 earnings, which dropped after the close on November 5th.
And this wasn't just a good quarter.
No, not at all. This was a strategically necessary quarter. For you, the listener, the mission here is to really understand how this execution transforms the whole narrative.
The narrative that was dominated by activist pressure.
Exactly. It shifts the conversation from, fix or sell to something much more powerful, self-help plus optionality.
Okay, so let's unpack that performance because the headline numbers were dramatic. We're talking about a textbook definition of a beat and raise.
A huge one.
On the bottom line, non-GAAP diluted EPS hit 55 cents.
And the street was only expecting about 39 cents.
That's a beat of nearly 40%.
That kind of gap beating consensus by 40+% just shows that the operational focus is really, really locking in.
And the momentum was just as strong on the top line.
Oh, absolutely. Total revenue came in at $224.2 million.
Which didn't just meet consensus, it actually exceeded the high end of their own guidance.
Right. And that reflects 21% growth year over year. Very solid.
And crucially, the engine of future value, annual recurring revenues.
The ARR.
It continued its acceleration. It hit $838.2 million.
Growing 22.5% year over year. And again, this wasn't just checking boxes. They exceeded consensus estimates on ARR by a noticeable margin.
So this is where that self-help narrative you mentioned really starts to shine, the rigor they've applied to efficiency.
Yes, we saw a massive swing in profitability. GAAP EPS, which was a loss of 31 cents a year ago, swung to a modest profit of 5 cents. That is just phenomenal operational leverage.
So how visible was that leverage in the numbers?
Extremely visible. Non-GAAP operating margin reached 12.7%.
And compared to last year?
Listen to this number. That's an 860 basis point improvement compared to Q3 of the previous year.
Wow.
They aren't just growing, they are demonstrating efficiency at scale. And on top of that, they're generating serious cash now.
Okay.
Free cash flow was $46.1 million in the quarter.
Which pushed their FCF margin to?
20.5%. That margin more than doubled year over year. This performance, it fundamentally changes the financial profile of the company.
That transition from just a growth story to a growth plus efficiency story really sets the stage for our deep dive into the drivers.
Right. This wasn't financial engineering.
It was about driving quality revenue. So let's look at the mix. Subscription revenue grew 23% year over year,
reaching $210 million. That just cements the high margin SaaS profile.
Now, what's interesting is that professional services revenue stayed flat.
Right, at around $15 million. But this isn't a failure. It's a very deliberate strategic choice.
The choice to do what? Exactly.
Management has been clear they are intentionally shifting those low-margin implementation and setup services over to their partner ecosystem.
And that's crucial for protecting those improved operating margins we just talked about.
Exactly. It's a key part of the whole efficiency story.
That strategic shift makes the large deal metrics even more critical then. It shows they're selling complex platform solutions that partners can then go and implement.
Yes, exactly. You can see it in the expansion trends. Look at customers with an annual contract value, or ACV, over $500,000.
Wow.
That cohort increased 42% year over year.
And contracts over $300,000.
Increased 41% year over year. These are huge jumps. It shows serious expansion within their existing base.
So this really confirms they're moving away from being seen as just a reporting tool and more toward being the unified platform of record.
And their net revenue retention rate of 114%, up from 111% a year ago, it just absolutely solidifies that expansion story.
I have to push on that services transition, though. Is the partner ecosystem truly mature enough to handle this volume yet?
That's a fair challenge.
Or are they risking implementation delays just to juice the margin?
Well, management addressed this. They emphasized that focusing on high-quality services partners lets them scale faster than if they tried to hire all those consultants themselves.
So it's an acceleration strategy.
It is. They said they're winning multi-solution deals at scale because they can rely on this robust partner network.
And the numbers back that up.
They do.
Yeah.
73% of their subscription revenue now comes from customers using multiple Workiva solutions. The market is consolidating, and the platform is winning.
And this platform dominance brings us to their core advantage, connecting all those different functions in the CFO's office.
Financial reporting, sustainability, and GRC.
And for our listeners, GRC is governance, risk, and compliance.
It's the infrastructure that makes sure a company is playing by the rules. But the key here is integration.
Right.
Workiva is positioning itself as the AI-enabled leader for that unified office of the CFO, but their AI strategy is what really separates them.
This is where it gets really interesting. What makes their AI unique compared to others who are just, summarizing documents?
It's all about the data structure underneath. The Workiva platform makes sure data is structured, consistent, and machine-readable from the get-go.
Before the AI even touches it.
Exactly. This transforms a standard report, which is often just a static PDF, into what they call a validated data product.
And what's the practical impact of a validated data product?
It means the output from the AI is auditable, it's trustworthy. If a regulator asks how the AI got a key metric, you can trace the data all the way back to its source.
With controls and assurance embedded along the way.
Precisely. They're not just bolting AI onto static documents. They're making AI a reliable part of the control environment. For a CFO, that's everything.
They gave some fantastic anecdotes that illustrate this multi-solution pull.
They did.
We heard about a global pharma company that nearly tripled its spend.
Yes. That pharma giant added sustainability and policy management solutions, expanded their deal into a mid-six-figure contract.
But the bigger one was the European energy company.
Oh, that was the most powerful case study. They started with just ESG reporting. Expanded their commitment more than eightfold. They now spend over $1 million in subscription revenue across 6 different solutions.
Eightfold expansion. That's incredible.
And that win was explicitly competitive. They displaced multiple dedicated GRC and sustainability vendors. It shows the platform approach is winning.
And this isn't just a U.S. story.
Not at all. International revenue is now over 19% of total sales, with really strong multi-product wins in Europe, driven by all the new regulations over there.
Okay, moving on to guidance. That Q3 performance gave them the confidence to materially raise their targets.
A lot of confidence.
For Q4 2025, they guided revenue to be between $234 and $236 million, which is well above prior expectations.
And adjusted EPS is guided to a very strong 67 to 70 cents.
And they lifted the full-year targets substantially.
Yep, they raised full-year revenue to $880 to $882 million. Full-year adjusted EPS raised to about $1.67 at the midpoint.
And importantly, they raised the full-year FCF margin guidance back up to around 12%.
Right, reiterating that commitment to financial discipline.
They also gave some early commentary on 2026.
A little peek. They noted that with the continued shift of services to partners, they expect services revenue to be relatively flat next year.
But they did reiterate the commitment to their aggressive 2027 medium-term goals.
And that long-term commitment is made so much more believable by the major leadership announcement they made.
The new CRO.
Yes. They're bringing in Michael Pinto as the new Chief Revenue Officer.
Pinto is a serious hire. He comes from huge scaling roles at places like Databricks, AWS, and SAP.
A very serious hire.
So what does this hire signal to the market?
It signals a focused push to accelerate profitable growth by, systematizing their go-to-market engine.
His background is in hyperscale cloud environments and maximizing channel partners.
Which links right back to that strategic decision to offload implementation services. His mandate is crystal clear. Scale the partner ecosystem and accelerate the displacement of legacy systems.
So this hire is basically the physical manifestation of their commitment to those 2027 targets.
I think that's the perfect way to put it.
You mentioned the operational discipline earlier. They raised the full-year operating margin guidance by 400 basis points year to date.
It's a holistic focus. Organizational redesign, internal process automation.
Including using AI on themselves.
Yes, and just strong fiscal discipline everywhere. This isn't a one-time boost. It's a structural re-rating of their operating model.
So let's connect this back to the broader investor context.
Mm-hmm.
The activist presence of Irenic Capital has loomed large all year.
It has.
How does this stellar Q3 execution play against that?
Well, the activist stake is still important. It provides a layer of what you could call option value that keeps pressure on management for capital allocation.
Okay.
But this Q3 performance is the strongest possible defense of the self-help thesis. It shows the current strategy is delivering real, measurable value without needing a forced sale.
And the execution is narrowing that performance gap the stock had with the software sector ETF, the IGV.
It is. The sell side responded with a lot of conviction, too. We saw firms like Truist raise their price target dramatically from $95 up to $110.
Which reflects a lot more belief in the sustainability of the story.
Exactly. And this is the perfect setup for our next segment. The question for the market If this AI-enabled platform is accelerating its wins, how do you capture that value shift?
This is not financial advice.
Hmm.
Let's hear your outrageous but plausible trade idea, built on the strength of this quarter.
Okay. The thesis is that the combination of this strong execution, the AI-driven compliance tailwinds, and bringing in a hyperscale CRO like Pinto, well, it positions WK for accelerated relative outperformance.
So lay out the play.
We pitch a relative value trade. Go long WK stock versus short, a curated basket of smaller legacy on-premise GRC and risk reporting software vendors.
So you're betting on pure platform consolidation.
That's the bet. The large multi-solution deals WK is winning, like that European energy company replacing 6 systems, are actively displacing these specialized competitors who just lack the unified platform.
So you're betting Workiva's valuation multiple goes higher, while the lack of scale and tech disadvantage pushes the legacy vendors lower.
Precisely. The new CRO's mandate to scale the go-to-market operations suggests that the pace of these displacement wins is only going to accelerate. That just increases the performance gap between them.
A compelling call built on a massive EPS beat, operational rigor, raised guidance, and the strategic confusion of some serious leadership talent.
Absolutely. Given the clear shift in the company's story from a niche filing tool to an integrated AI-enabled platform, the final question for you, the listener, is this. Has the stock price, which still modestly lagged its peers over the last 12 months, now fully decoupled from its previous volatility to justify a new, higher growth trajectory well into 2026 and beyond? It seems the numbers are finally making that case.